Picture this. It's Friday afternoon. You clock out, hop in the car, and drive 2 hours to your place. Not a hotel, your cabin by the lake. You wake up Saturday morning, coffee on the deck, zero stress. That is the American dream, right? Now picture this. It's Friday afternoon, you get a call. The toilet exploded at your rental property. You aren't relaxing, you're writing a check to a plumber. But 10 years from now, that exploding toilet paid for your retirement. Here is the truth that real estate agents are terrified to tell you. One of these properties is the luxury item that will bleed your bank account dry while convincing you you're wealthy. The other is a boring, unsexy money printer that could make you a millionaire. And the worst mistake you can make? Trying to turn one into the other. Today, we are settling the debate once and for all. Second home versus investment property. The tax loopholes, the lending lies, and the 14-day rule that could trigger an audit from the IRS. Let's dive in. Hey everyone, welcome back to the channel. If you're new here, we talk about building wealth without falling for the financial traps that keep most people broke. So you have some cash saved up. Maybe your primary home has appreciated and you're sitting on some equity. You're thinking, I should buy real estate. But here is where 90% of beginners mess up. They think a second home and an investment property are just different names for the same thing. To you, maybe. To the bank, they are different planets. Let's talk about the money first. When you go to a bank, Wells Fargo, Chase, whoever, and say, I want to buy a vacation home, they smile. Why? Because second home loans usually have interest rates very similar to your primary residence. They might require only 10% down. But walk in and say, I want to buy a rental property to lease out, and watch the mood change. Suddenly, they want 20% or 25% down. The interest rate jumps up by 0.5 to 1%. They want to see cash reserves. They treat you like a business, not a homeowner. So the temptation is obvious. You think, I'll just tell the bank it's a vacation home to get the cheap rate, but then I'll rent it out full time. Stop. Do not do that. That is called occupancy fraud. The FBI investigates it. If you sign a mortgage affidavit saying you will occupy the home and you lease it out immediately, you are committing bank fraud. Do not pass go. Do not collect $200. So we have to play by the rules. Let's break down the actual financial reality of the second home first. The second home, the vacation spot. The biggest pro here isn't financial, it's psychological. It's guaranteed access to your happy place. You don't have to pack as much because you leave your clothes there. You know the neighbors, it becomes a legacy for your kids. But let's look at the math. A second home is a liability. I don't care what your uncle says. If it takes money out of your pocket every month, it is a liability. You have the mortgage, but you also have double the utilities, double the insurance, and by the way, insurance on a beach house in Florida or a cabin in California fire country, it is skyrocketing. And here's the kicker for my US audience, the Tax Cuts and Jobs Act. Currently, you can only deduct mortgage interest on up to $750,000 of debt. That is total debt. If your primary home has a $500,000 mortgage and you buy a vacation home with a $400,000 mortgage, you are over the limit. You don't get a tax break on that extra debt. Also, the SALT cap. You can only deduct $10,000 in state and local taxes. If you own 2 homes, you're hitting that cap instantly. So, financially, a second home is a luxury consumption item, like buying a really expensive boat that doesn't float. Now, let's look at the investment property. This is pure business. You aren't buying this because you love the view. You're buying it because the numbers make sense. Here's why the wealthy love this. It's called the phantom expense or depreciation. Let's say you buy a rental for $300,000. The IRS lets you depreciate the building, not the land, over 27.5 years. That means every year you get to tell the IRS, hey, my building lost value, and you deduct that loss from your income. But did the building actually lose value? No. In the US market, it probably went up in value. So you get cash flow from rent, price appreciation from the market, and a tax write-off on paper. It is the holy grail of finance. Plus the 1031 exchange. When you sell your vacation home, if it went up in value, you pay capital gains tax. Ouch. When you sell an investment property, you can use a Section 1031 exchange to roll all that profit into a bigger property without paying a dime in taxes today. You can defer taxes until you die. The downside? It's work. Tenants call at 2 a.m., toilets break, the economy dips, and people stop paying rent. It's not a vacation, it's a part-time job. Now, I know what you're thinking. But wait, can't I buy a vacation home, use it sometimes, and rent it out on Airbnb the rest of the time? Best of both worlds. This is what I call the hybrid trap, and this is where the IRS is waiting for you with a clipboard. Welcome to the Augusta Rule versus the 14-day rule. Scenario A is the Augusta Rule. If you rent your home out for less than 15 days a year, you don't have to report that income. It's tax-free. Great for Super Bowl weeks. Scenario B is the vacation home rule. This is where most of you will fall. If you use the home personally for more than 14 days or 10% of the days it's rented, the IRS classifies it as a personal residence. Why does this matter? Because if it's a personal residence, you cannot deduct rental losses. Let's say you spend $20,000 fixing up the house for Airbnb guests, but you also stayed there for 3 weeks in July. You can't use those expenses to offset your W-2 income. You're stuck. Also, managing a short-term rental is not passive income. It is the hospitality business. You are running a hotel. Do you want to run a hotel? Because if you just wanted a place to chill on weekends, cleaning up after a bachelorette party every Sunday is not chilling. So, decision time. Which one should you choose? Choose the second home if 1. You have a net worth of at least $1 million or high disposable income. 2. You are okay with losing $2,000 to $4,000 a month for the privilege of ownership. And 3. You plan to keep it for 20 plus years for your family. Don't view it as an investment. View it like a car. You enjoy it, but it costs you money. Choose the investment property if 1. You are still in the wealth accumulation phase and you want to retire early. 2. You are willing to deal with headaches to get tax breaks and appreciation. And 3. You want someone else, the tenant, to pay off your mortgage. My advice, if you aren't financially free yet, buy the investment property first. Let the cash flow from the investment property pay for your vacations. Don't buy the liability until your assets can pay for it. I want to hear from you guys in the comments. Are you team lake house or team duplex? Have any of you tried the Airbnb route and regretted it? Let me know down below. If you found value in this video, do me a favor, destroy the like button for the YouTube algorithm. It really helps the channel grow. Don't forget to subscribe if you want to master your money. I'll see you in the next video. Keep building.